In a world built on contracts and trust, a shadow economy is thriving right under the nose of global corporations. Sales are happening. Every second, a transaction is made. Customers are paying, the coffee is poured, the burger is served, the service is rendered, and the system is recording something else entirely. Behind the high-speed efficiency of your favorite franchise, a silent leak is draining millions. What if part of the revenue, the very lifeblood of the brand, was never reported? Welcome to Corporate Secrets. Today, we peel back the digital curtain on franchise revenue hiding. The numbers you see are only the surface. The real story lies in the data that never reaches the dashboard. This is the multi-billion-dollar gap that keeps executives awake at night. The modern franchise model is a masterpiece of scalability. It depends on a fundamental pillar: trust. A parent company provides the brand, the supply chain, and the blueprint for success. In return, the operator provides local management and a commitment to transparency. Reported sales drive royalties, and these royalties fund the innovation that keeps the brand alive. Numbers define performance. They are the language of the boardroom. But when the language is manipulated, the entire structure begins to crumble. For a global brand, the integrity of local reporting isn't just a detail. It's the foundation of their market valuation. Without accurate data, the corporation is flying blind, relying on a map that has been intentionally redrawn by those on the ground. But what if the numbers you see are only part of the truth? Investigative audits across various sectors have revealed a staggering discrepancy. In some cases, up to 30% of actual revenue is siphoned off before it ever hits a corporate server. This is the hidden gap. It's not just a rounding error. It's a calculated systemic extraction of wealth. For a franchise network worth $1 billion, a 10% leak translates to $100 million in missing royalties every year. This isn't just about small-time skimming. It's a sophisticated bypass of the global financial plumbing that connects the outlet to the headquarters. Understanding how this happens requires us to look past the customer-facing counters and into the heart of the digital infrastructure. It begins with the gateway of every transaction, the point-of-sale system. Franchise operators control these local terminals. They are the gatekeepers of the data. And in the world of corporate fraud, control creates opportunity. Modern POS systems are designed to be foolproof, but for an operator with the right access, they are surprisingly malleable. Whether it's through training modes that never get turned off, or administrative overrides that allow for corrections after the customer has left, the terminal is the first point of failure. When an operator can decide which keystrokes are permanent and which are temporary, the integrity of the entire supply chain is compromised. This is where the paper trail is intentionally broken right at the moment of creation. Some sales are recorded with surgical precision. Others happen in a parallel universe outside the system entirely. In the industry, these are known as off-book transactions. It's as simple as cash-only signs during peak hours or system outages that conveniently occur every Friday night. While the customer receives their product, the corporation receives nothing. No record of the inventory used, no record of the labor spent, and most importantly, no record of the revenue generated. These parallel transactions are the most difficult to detect because they never leave a digital footprint. They exist only in the physical exchange of currency, hidden in the pockets of the operator and wiped clean from the day's official history. It's a ghost economy, invisible to even the most advanced AI monitoring. For those transactions that do make it into the system, the manipulation is even more calculated. Data can be altered, adjusted, or removed completely during the end-of-day reconciliation. Voids, refunds, and complementary items become the camouflage for theft. An operator might record a high-value sale as a simple discount, pocketing the difference while keeping the inventory counts just plausible enough to pass a cursory check. This is data laundering. It requires an intimate knowledge of the corporate audit filters. By staying just below the threshold of an automated alert, the fraudster ensures that the manipulated records blend seamlessly into the noise of thousands of other locations. It is a slow, methodical erasure of profit, executed one click at a time. Revenue is split between what is shown to the world and what is hidden in the dark. Skimming is an art form of deception. It's not about taking everything. It's about taking enough to make a difference, but not enough to be noticed. The skimmed cash is often funneled into secondary accounts or used to pay off-the-books expenses, further complicating the audit trail. In the mind of the rogue operator, this isn't stealing, it's optimizing their local profit. But for the parent company, it is a direct assault on the brand's viability. This hidden pool of capital creates a distorted reality where a location appears to be struggling on paper, while in reality, it is a gold mine for the person holding the keys. It is a betrayal of the franchise agreement, hidden in plain sight. To keep the scheme alive, the numbers are kept within believable limits. To avoid suspicion, a sudden drop in revenue would trigger a red flag. Instead, the rogue operator maintains a false plateau. They ensure that the reported growth matches the regional average, even if their actual location is far outperforming it. This psychological manipulation of data is the most dangerous. It uses the auditor's own expectations against them. By feeding the system exactly what it expects to see, the fraudster creates a sense of security. They understand that as long as the trends look stable, nobody will look closer. It is the ultimate hiding place, the average. In a sea of data, the most invisible thing is the one that looks perfectly normal. The impact on the parent corporation is immediate and devastating. Lower reported sales mean lower royalties. These are the funds that drive global marketing, research and development, and infrastructure support. When a significant portion of the network is underreporting, the brand loses its competitive edge. It cannot reinvest in the very systems that could detect the fraud. It's a vicious cycle. The corporation sees a decline in performance and reacts by cutting costs, while the rogue operators continue to thrive on the hidden surplus. This loss of capital stunts the entire ecosystem, punishing the honest franchisees who are playing by the rules and paying their fair share. The hidden gap isn't just a loss of money, it's a loss of the future. Because trends look stable, no alarms are triggered. The standard audit tools are designed to catch outliers, the massive spikes or the sudden crashes. They are not designed to catch the steady leak. In a recent investigation of a global retail chain, it was discovered that over 50 locations had been underreporting for years, right under the nose of the regional managers. The total exposure? A staggering $8 million in revenue loss risk per year. This was a silent hemorrhage, invisible to the very people hired to stop it. The tragedy of revenue hiding is that it often occurs in the most consistent locations, the ones that management trusts the most. The lack of suspicion is the fraudster's greatest weapon. The failure starts at the top. Corporates trust reported data without questioning its source. There is an over-reliance on automated reports that are only as good as the data being fed into them. If the input is compromised at the local level, the entire global analysis is a fiction. We have entered an era where data is king, but we have forgotten that kings can be deceived. When management stops conducting physical, unannounced spot checks and relies solely on the digital dashboard, they cede control to the operator. The dashboard becomes a theater of performance, a curated reality designed to keep the auditors satisfied while the real action happens in the shadows. Verification must move beyond the screen and back into the physical world. One of the biggest vulnerabilities is the lack of real-time monitoring. Without live validation of every transaction, there is a window of opportunity between the sale and the report. This is where the manipulation happens. Disconnected systems create pockets of invisibility. If the inventory system isn't linked to the POS, and the POS isn't linked to the bank deposit in real time, the hidden gap can exist indefinitely. A sale that isn't validated immediately can be deleted before the end-of-day sync. This lag is the fraudster's best friend. In a world of high-speed fiber optics, it is the intentional delays in data flow that allow for the most significant financial crimes. True visibility requires a seamless, real-time pulse of every location, leaving no room for the shadow audit. The warning signals are there, if you know where to look. High customer activity, but low reported revenue, is the most obvious red flag. Mismatched footfall data versus POS entries is a smoking gun. Unusual consistency in numbers, a location that never has a bad day or an exceptionally good one, suggests the data is being curated. When the inventory usage doesn't match the sales, or when waste and voids spike during peak hours, the story is being told. These red flags are the whispers of a hidden truth. Detecting them requires more than just looking at the bottom line. It requires an investigative mindset that looks for the friction between the physical reality and the digital report. The truth is always in the discrepancy. The lesson is clear. Trust, without verification, creates blind spots. To protect the brand, corporations must move toward integrated systems, immutable audit trails, and real-time AI analytics. The future of franchise management is in assurance, not just criticism. By implementing systems that automatically cross-verify sales with inventory and bank records, the opportunity for fraud is eliminated. This isn't about policing, it's about protection. Protection for the brand, for the shareholders, and for the honest operators who thrive on a level playing field. When the data is beyond manipulation, the focus can return to what matters most: growth, innovation, and the customer experience. Verification is the ultimate form of brand security. As franchise networks expand, the risk scales with them. What starts as a small leak in one location can grow into massive invisible losses across a global network. In the digital age, the most dangerous threat isn't an external hacker. It's the trusted insider who knows how to work the system. Hidden revenue is a systemic infection. If left untreated, it can devalue even the strongest brands. The twist: often, the most successful managers are the ones who have mastered the art of the hide. The person you trust the most might be the one causing the most damage. In the world of corporate secrets, the biggest risks aren't the ones you see coming. They're the ones that are intentionally kept out of sight. Keep your eyes open. The data never lies, but the people who enter it often do. If this video opened your eyes, like, share, comment your thoughts, and subscribe to Corporate Secrets.